That whole idea of Bitcoin being a shield from global economic chaos, well, that narrative just took a serious hit. A perfect storm of bad news, sticky inflation data, and jitters from regulators sent the entire market into a tailspin. And Bitcoin, the asset we were told was our digital fortress, the so called digital gold, crashed right along with everything else. The drop was so sharp, so brutal, that it forces us to ask the hard question. Is Bitcoin really an independent asset, a true safe haven? Or is it just another pawn in the grand macroeconomic game tossed around by the same forces that dictate the fate of stocks? What just happened wasn't just a price dip, it was a live stress test, a real world experiment that put one of crypto's biggest promises on trial. And the initial verdict is not great. Today, we're going to dissect what happened, why it happened, and what this all means for the future of Bitcoin and your portfolio. This isn't about panicking, it's about understanding. Because in moments like this, clarity is the most valuable asset you can possibly own. To really get what happened, we need to look at the catalyst that lit the fuse. This wasn't a single event, but a potent cocktail of fear, uncertainty, and doubt brewing in the broader economy. It started with troubling US inflation data that came in hotter than expected, spooking investors who worried it would force the Federal Reserve to keep interest rates higher for longer. At the same time, whispers of potential delays in new ETF approvals added regulatory anxiety to the mix. The market's response was instantaneous and visceral. Before the storm hit, Bitcoin was trading with relative strength, holding steady in the $121,000 to $122,000 range. But as this wave of bad news washed over the market, the floor just gave out. The price plunged, slicing through support levels like they weren't even there. Before you knew it, Bitcoin was struggling to stay above $119,000, a significant drop in a single day. We're talking about a multi-thousand-dollar candle that wiped out days of gains in the blink of an eye. But the price chart only tells part of the story. To see the real carnage, you have to look under the hood at the world of leverage and liquidations. This is where the panic truly hit the accelerator. As the price fell, it triggered a catastrophic cascade of automated selling. Traders who had bet on Bitcoin's price going up, the so-called longs, were suddenly and forcibly liquidated. Exchanges automatically closed their positions to cover their debts, pouring even more fuel on an already raging fire. The numbers are just staggering. In a single 24-hour period, nearly $700 million worth of these long positions were wiped out across the market. Think about that. Hundreds of millions of dollars in value erased. This wasn't a calculated retreat. It was a stampede for the exits, amplified by the brutal mechanics of a leveraged market. And let's be clear, this was not a Bitcoin only problem. The shockwave radiated across the entire crypto ecosystem. Ethereum, which is often even more volatile than Bitcoin, plummeted. Other major altcoins like Solana, XRP, and Cardano all suffered heavy losses. The contagion jumped from the assets themselves to the companies that support them. Crypto-related stocks like Coinbase, MicroStrategy, and Robinhood also took a hit as investors fled anything with exposure to the sector. It was a synchronized, systemic sell-off, a classic risk-off event where investors, gripped by fear, dumped anything they saw as volatile or speculative. The market's message was loud and clear. When major economic uncertainty strikes, Bitcoin is still treated not as a shield, but as a risk. Now, for anyone who's been in this space for a while, this kind of reaction feels like a betrayal of a core promise. To understand why, let's revisit that promise. Why did so many people believe Bitcoin would act differently? What was the digital gold narrative that just seemed to crumble? The safe haven idea is built on a few powerful concepts. The first and most important is decentralization. Unlike the US dollar or the euro, Bitcoin isn't controlled by any single government or central bank. There's no Fed to print more of it and devalue your holdings. No politician can weaponize it or freeze your access to it. It runs on a global network, resistant to censorship and political games. In a world where trust in institutions seems to be fading, this independence is supposed to be its superpower. The theory was simple. When nations play games that create economic chaos, a neutral asset should become a refuge. The second pillar is its scarcity. This is the digital gold part of the analogy. We know with mathematical certainty that there will only ever be 21 million Bitcoin. That's it. This hard cap is written into its code. This makes it a deflationary asset by design. While governments can and do print trillions to patch up economic crises, diluting their own currencies, Bitcoin's supply is finite. It's meant to be a hedge against inflation, a way to preserve wealth when money is losing its value. Combine those two ideas, decentralization decentralization and scarcity, and you get a very compelling story. Bitcoin was supposed to be the ultimate safe harbor in a storm. When trade tensions rise, when inflation spirals, when a government looks shaky, Bitcoin was meant to be the asset that stands apart. It was supposed to be uncorrelated. While stocks and bonds get caught in the crossfire, Bitcoin was supposed to be the lifeboat, quietly gaining value as investors flee the traditional system. This wasn't some fringe idea. It was a core part of the investment thesis for millions. It's why you hear digital gold and inflation hedge repeated like mantras. The expectation was that in a moment exactly like the one we just saw, a moment of sharp, unexpected economic fear, Bitcoin's value would either hold steady or more likely go up. This should have been its moment to shine. Instead, we saw the exact opposite. A beautiful theory collided head on with the ugly reality of market panic. The very event that should have proven the safe haven narrative right instead left it in tatters. Which brings us to the big question. If Bitcoin didn't act like digital gold, what did it act like? And why? So, if Bitcoin didn't behave like the independent safe haven we hoped for, what did it behave like? The answer, when you look at the charts, is simple and deeply unsettling for long-term believers. Bitcoin behaved exactly like a high-risk tech stock. Let's put the charts side by side. On one screen, Bitcoin's price during the sell-off. On the other, the NASDAQ 100, the index of the biggest tech companies. The resemblance is uncanny. As fear about inflation and interest rates swept through the markets, the NASDAQ tumbled. And as the NASDAQ tumbled, Bitcoin followed it right down, almost in lockstep. Both are seen as risk-on assets. They do great when investors are confident and optimistic, but they're the first things thrown overboard when fear takes hold. During this crisis, Bitcoin didn't decouple from the system. It got dragged down by the system. Now let's add another chart. Gold, the original safe haven. How did it do during the same period? While Bitcoin and tech stocks were in free fall, gold held its ground. It did what a safe haven is supposed to do. It acted as a store of value, a point of stability in the chaos. The contrast couldn't be more stark. On one side, the assets of the future, tech and crypto, plummeting together. On the other, a shiny metal from the past, providing the very stability Bitcoin was supposed to offer. This forces us to ask why. Why this tight, uncomfortable correlation? The answer lies in who invests in Bitcoin now. For its first decade, Bitcoin was mostly for cypherpunks, early adopters, and retail investors who believed in the ideology. But the game has changed. The institutions have arrived. Hedge funds, asset managers, and even pension funds have started adding Bitcoin to their portfolios. They see it as a way to get explosive growth. But here's the key. Most of them don't see it as a safe haven. They see it as a speculative tech investment. On their balance sheets, Bitcoin isn't sitting next to gold and bonds. It's sitting next to tech stocks and venture capital. It's firmly in the risk-on bucket. So when a macro shock happens, the mandate for these big money managers is simple. Reduce risk now. They sell their most volatile assets first to raise cash. And Bitcoin today ticks that box emphatically. It's famously volatile. And thanks to a multi-trillion-dollar market, it's now incredibly liquid. So when the sell risk alarm went off on trading desks, there was no philosophical debate. There was just a command, sell. They sold their NASDAQ positions and they sold their Bitcoin positions. Its integration into the traditional financial system, which we often celebrate as adoption, has a dark side. It means in moments of panic, Bitcoin's fate is tied to the very system it was designed to be an alternative to. As the old saying goes, all correlations go to one in a crisis, and Bitcoin is no exception. It didn't fail because of a flaw in its design, but because of how it's now used by the biggest pools of capital in the world. If understanding these deep market forces is something you find valuable and you want to get ahead of these shifts instead of just reacting to them, I highly encourage you to subscribe to our weekly newsletter. Every week, we go beyond the headlines to analyze the data, trends, and institutional behavior shaping the crypto market. We break down what you need to know to navigate this space with confidence. It's completely free, and it's the best way to stay informed. The link is right down in the description. Join the community of smart investors who are committed to understanding the why behind the price. Now, it would be easy to look at this event and just declare the digital gold narrative dead, but I think that's too simple. What we witnessed was not a fundamental failure of Bitcoin. It was a failure of the market's current perception of it. This isn't a final verdict, it's a progress report. And what it shows is that Bitcoin is in a messy, volatile, and absolutely crucial transitional phase. Let's be clear about what didn't happen. Bitcoin's protocol didn't break. It kept producing a new block every 10 minutes, like clockwork. Its 21 million coin supply cap didn't change. Its decentralization wasn't compromised. The fundamental properties that give Bitcoin its long term value are all still perfectly intact. The crash was a reflection of human psychology and an immature market, not a broken technology. The irony is that Bitcoin has become a victim of its own success. Its journey into the mainstream is precisely what made it vulnerable. It's become part of the financial machine before it's big enough to stand apart from it. Think of it like an asset in its adolescence. It has the revolutionary DNA of its adult self, scarcity, decentralization, but it's still living in its parents' house, subject to the rules and drama of the traditional financial system. It hasn't fully moved out yet. This phase is defined by a conflict in its identity. On one hand, you have a growing army of long term holders, the hodlers, who see it as a savings technology for the future. On the other hand, you have the world of fast money, hedge funds, and macro traders who treat Bitcoin as just another ticker on a screen. For now, this second group still dominates the day to day price action. The crash happened because the risk on traders overwhelmed the store of value accumulators in a moment of panic. Interestingly, even as the price fell, data on ETF flows was mixed, suggesting that while some were panic selling, more patient capital may have been using the dip as a buying opportunity. So, this event doesn't kill the long term thesis, it just highlights the journey still ahead. Bitcoin is in the chaotic, multi decade process of evolving from a speculative curiosity into a global store of value. This volatility, this failure to act as a perfect safe haven today, isn't a bug. It's a feature of its maturation. So, what will it take for Bitcoin to finally make that transition? How does it get from being a volatile risk on asset to a reliable risk off safe haven? The road ahead involves a few key milestones. First is simply broadening the holder base. For Bitcoin to be a true safe haven, it needs to be held by tens and eventually hundreds of millions of people and institutions globally. When a huge portion of the world holds Bitcoin for the long term, its price will be less susceptible to the whims of short term traders. The foundation will be too deep for speculative waves to cause a tsunami. Second is a reduction in the influence of leverage. The recent crash was poured gasoline on by the cascade of liquidations. That's a sign of a market still in its speculative youth. As the market matures, the size of the spot market, people owning actual Bitcoin, will hopefully dwarf the derivatives market, leading to a more stable asset. Third, and perhaps most simply, it just needs more time. Gold has a track record spanning millennia. The US dollar has been the world's reserve currency for nearly a century. Bitcoin has been around for just over a decade. It needs more time to prove itself through multiple economic cycles, recessions, inflation, and financial crises. With each crisis it successfully navigates, its credibility grows. Perhaps we're asking the wrong question. We ask, is Bitcoin a safe haven? As a simple yes or no. But maybe it's evolving into something new, an asset that acts as a speculative play during short-term liquidity shocks, but as a safe haven during long-term threats like currency debasement or institutional decay. This crash was a market liquidity shock. It has not yet been truly tested by a sovereign level crisis in a major economy. Its performance in that scenario could be completely different. So, where does that leave us? We started with a provocative claim. Bitcoin just failed its ultimate safe haven test. We saw the narrative of a political and economic shield get shattered by the reality of a market crash. We saw its tight correlation with risky tech stocks laid bare for all to see. But then we dug deeper. We found this wasn't a failure of Bitcoin's code, but a consequence of its adolescence, a period where it's caught between short-term traders and long-term believers. Its integration into the traditional system made it vulnerable to that system's panic attacks. This leads us to a new, more refined understanding. Bitcoin didn't fail its long-term value proposition. It failed the market's current immature perception of it. The event was a painful but necessary stress test that revealed both its present day weaknesses and the path it must take to build its future strengths. It's a reminder that while Bitcoin is revolutionary, it's not immune to the laws of market gravity, at least not yet. And that leaves us with the final, most important question, which is for you. What do you think? Was this crash a fatal blow to the safe haven narrative? Or was it just the inevitable growing pains of a revolutionary asset finding its place in the world? Let me know your thoughts in the comments below.